Good morning, students. Today we are discussing about how we can prepare banking company accounts. Here, basically, when we are talking about banking company, we must know what is a bank. Bank is basically a place at which we are accepting the deposits or withdrawing our deposits. So basically, that must be got a license from RBI before making a act of banking company, that is banking rules of 1949. And there must be a act that is maintained by that is prepared by RBI in 1934 and 1935. Then afterwards, Banking Regulation Act that should be prepared in 1949, that prescribes the preparation and presentation of final accounts of a banking company and has divided financial accounts in various forms and schedules, which include various basically two type of forms. One is Form A, which contains a balance sheet a schedule from 1 to 12, and Form B, uh, profit and loss account, which contains a schedule of 13 to 16. So there are basically 16 schedules we have to maintain for making final accounts of a banking company. When we are talking about a financial year, we know that a financial year ends at 31st of March every year, and banks also prepare half yearly accounts on 30th of September of every year. So, submission of annual accounts to the various authorities. Basically, there are some authorities to whom we have to submit the final accounts, as we know that that can be published in the uh, magazines, or we can say annual reports. So, there are three copies along with auditor report to the RBI within 3 months from the end of financial period. Three copies along with the auditor report to ROC. ROC here stands for Registrar of Companies. Each copy along with auditor report to be presented to each shareholder in AGM. AGM stands for Annual General Meeting. For getting approval from the shareholders must be published in newspaper circulating at a place where the bank has its registered office within 6 months from the end of a financial year. So we'll move to the formats which are to be followed for preparing a balance sheet of a banking company. We know that that is a Form A. So here, when we are talking about balance sheet format, that should be contain three columns: particulars, schedule, and amount for the current year. Even you can prepare one more column which is for the previous year, so we can compare the two statements. So here, when we are talking about capital and liabilities, first schedule is maintained for capital, second is for reserves and surplus, third is for deposits, various kind of deposits such as fixed deposits, saving deposits. As a customer deposit into the bank, so there is a liability of the bank, they have to pay to the customer back after some tenure. There are basically two type of deposits. One is time deposits such as fixed deposit, and another is demand deposits such as you can say saving deposits. So borrowings we can prepare for under a schedule 4. Then other liabilities and provisions, if there is any current liability, that should be prepared under 5th schedule, or provision, any kind of provision should be prepared under schedule 5th. Then assets include, first is cash and bank balance with RBI under schedule 6, balance with banks and money at call and short notice. So if we are talking about the first point, that is cash and bank balance with RBI, that is under schedule 6. So if we are talking about, there are two type of ratios. One is called cash reserve ratio, that we have to maintain with the RBI. as a security in form of cash. So that is known as cash reserve ratio. Then another point is SLR, that is statutory liquidity ratio. We have to maintain some percentage of minimum percentage of time and demand deposits with us so as to liquidate the or meet the liabilities to the customers. So the cash and bank balance with the RBI should be maintained under Schedule 6. Balance with banks, balance with other banks, or money at call and short notice. Sometimes bank give loans to the customer for 14 days or less than 14 days. That is called money at call and short notice. So that should be prepared at Schedule 7. Investments at 8, advances at 9, fixed assets at 10, other assets are at 11. So basically there are 11 schedules which are to be maintained within a balance sheet. As a footnote, we have to maintain a contingent liabilities which may or may not happen. Then the last one is schedule 12, that should be maintained for bill for collections. Bill for collections are basically maintained as a footnote in the balance sheet, as we know that should be occurred or that should be accrued or due in the next year. So that should be maintained under schedule 12 as a bill for collection as a footnote of the balance sheet. So we will discuss one by one as per the schedules. As we can see, there is a schedule 1 that is for capital. For nationalized bank, there are two type of banks, nationalized or other banks. So nationalized banks are basically the fully owned by the central government. So these are these have maintained a capital as capital. So second, for banks incorporated outside India, so we have a capital from outside India or by the RBI. And for other banks, we have a share capital, such as we have studied in share capital, already studied in share capital. Then there is a reserves and surpluses under schedule 2. There are some statutory reserves such as SLR, CRR, repo rate, reverse repo rate. So we have to maintain that reserves. Capital reserve, if there is any capital profit, that should be maintained under a capital reserve. Share premium, if there is any share premium, we have issued a shares and we get a premium, so that should be treated here. Revenue and other reserves, if there is any other reserve, that should be maintained out of a profit of every year, so that is reserves, revenue and other reserves. Balance in profit and loss account, if there is any balance which is left in the profit and loss account, that should be maintained here. So we will add all the 5 points for reserves and surpluses. So, after every point there is some adjustment. There is a opening balance, addition during the year, deduction during the year. So we'll add additions and deduction should be deducted. Then there is a schedule 3 for deposits. Deposits are basically demand deposits from the bank or from others. Then next is saving bank deposits, then term deposits from banks and from others. So we'll add all the three, that is called deposits. Then for B, deposits of other branches in India and deposits of branches outside India. Then if we will add all the points that comes as deposits, schedule 4, borrowings in India and borrowings outside India. Borrowings in India are basically contained as Reserve Bank of India, borrowings from Reserve Bank of India, from other banks, from other institutes, and advances. So borrowings, if we will add all the 2 points, borrowings in India and borrowings outside India, so we will get fourth schedule. Schedule number 5, other liabilities and provisions. Here we will add bills payable, inter office adjustment, if we will transfer from one office to another office, that should be adjusted. Then interest accrued and others including provisions. So if we will add all the 4 points, then we will get schedule 5. Schedule 6, cash and balance with the bank RBI, that is cash in hand, include foreign currency notes, as we know that banks are also deal in forex. Balance with RBI, that is in current account and in other accounts. If we will add first point and second point, then we will get cash and balance with RBI as per schedule 6. Schedule 7, balance with banks and money at call and short notice. Again, that will include the two parts in India and outside India. So here we will add the 2 points in India and 3 points in outside India. Banks, balance with banks in current account and in other deposits, money at call and short notice with banks and with other institutes. Outside India, in current accounts, in other deposit accounts, money at call and short notice. If we will add in India and outside India, then we will get schedule number 7 as balance with banks and money at call and short notice. Then schedule 8, there are some investments again that are in India and that are outside India. So here investments are made in government securities, other approved securities, shares, debentures, bonds, subsidiaries, joint venture and others. Outside India again there are government securities, subsidiaries, joint ventures and other investments. If we will add first point in India and second point outside India, then we will get investment as per schedule 8. Then advances. Advances include bill purchased and discounted, cash credit overdrafts and loans payable on demand, term deposits secured by tangible assets covered by bank, government guarantees, unsecured advances in India, priority sector. Priority sector is basically agriculture sector, public sector, banks and others. Advances outside India, due from banks, due from others, bill purchased and discounted, syndicated loans, others. So if we will add all the 3 points, A, B plus C, then we will get advances as per schedule 9. Schedule 10. Schedule 10 includes fixed assets. As we know that fixed assets can be used for a longer period of time. So here we will add all the long-term assets like premises. If there should be added as cost on 31st of March of the preceding year in the last year, and addition if any, deduction if any. Addition stands for purchase of that other premises and deduction stands for, you can say, the sale of that premise, and depreciation on that date, on the last date of the year. Other fixed assets including furniture, fixtures, etc. Again, the adjustment should be same. At cost we will record it of the preceding year, then addition during the year if any purchase, deduction any sale, then depreciation to the date. So if we will add the first point and the second point, then we will get total fixed assets as per schedule 10. Schedule 11, other assets. Inter-office adjustments, interest accrued, tax paid in advance, tax deducted at source. Tax deducted at source is basically known as TDS. Again, that is also known as tax paid in advance. Sometime if we have an income in cash more than 15,000, then 10% tax should be deducted. So same like that, TDS is basically a tax which is paid in advance in advance means that is before the due date. Then at the fourth point, stationery and stamps, non-banking assets acquired in satisfaction of the claims. Sometime we have invested some money outside the banking operations, that is again for the satisfaction of the claims. So that are non-banking assets. Other, if any, uh, here we have marked at in case there is any unadjusted balance of loss, the same may be shown under the item of appropriate footnote. So there is a footnote, that is a contingent liability as per schedule 12, claim against the bank not acknowledged as debt, liability for partially paid investment, liability on account of outstanding forward exchange contracts, guarantee given on behalf of consequents in India and outside India, acceptance, endorsements, and other obligations, other items for which the bank is contingently liable. So if we will add all the 6 points, then we will get contingent liabilities as per footnote. Bills for exchange we will discuss in the further lecture, that is bills for collection, or we can say rebate on bill discounted. Then we will study the how we can prepare a profit and loss account as per form B. uh, there are schedules between 13 to 16